Have you ever wondered how businesses ensure their financial statements accurately reflect their financial performance and position? Well, adjusting entries in accounting play a vital role in achieving this. They allow companies to align their books with the accrual basis of accounting, ensuring that revenues are recognized when earned and expenses are recorded when incurred, regardless of when cash transactions occur. But what exactly are adjusting entries, and why are they necessary? Let's delve into the world of adjusting entries and uncover the answers together. Unlock the secret to financial success with Counting Coins, where numbers come alive and your accounting game thrives. Now let's talk about adjusting entries. These are journal entries that we make at the end of each accounting period, and they play a crucial role in aligning our books with the accrual basis of accounting. But what does that even mean? Well, buckle up because we're about to embark on a journey to demystify this concept. Before we dive into the nitty-gritty details, let's take a step back and look at the bigger picture of financial accounting. At its core, financial accounting involves recording, summarizing, and analyzing a company's financial transactions. The goal is to present this information in the form of financial statements, which provide valuable insights to investors, lenders, and creditors, helping them make informed decisions. Now, when it comes to preparing financial statements, we need to follow certain rules. These rules can vary slightly from country to country, but generally, we adhere to the Generally Accepted Accounting Principles or GAAP or the International Financial Reporting Standards or IFRS. Both GAAP and IFRS require us to prepare financial statements based on the accrual basis of accounting. But what exactly is the accrual basis of accounting? Simply put, it's a method where we recognize revenue when it is earned and expenses when they are incurred, regardless of when cash is received or paid. This is in contrast to the cash method of accounting, where revenue and expenses are recognized only when cash transactions occur. Now, you might be wondering, why is the accrual basis so important? Well, it's all about accurately reflecting the financial performance, position, and cash flow of a business. By recognizing revenue and expenses based on when they are earned or incurred, we can provide a more comprehensive and meaningful picture of a company's financial health. But here's where things can get a bit tricky. The timing of cash transactions or invoices may not always align with when revenue is earned or expenses are incurred. That's where adjusting entries come into play. They are like the superheroes of the accounting world, swooping in to save the day and bring our books into alignment with the accrual basis. So let's break it down further. Picture a typical business transaction involving a buyer and a seller. The seller provides goods or services to the buyer, and in return, the buyer pays them or receives an invoice. This transaction has three components: the transfer of goods or services, the invoice, and the payment. Now, if all three parts of the transaction occur within the same accounting period, that's great. No adjusting entries are needed. However, when these components fall into different accounting periods, we face a challenge. This is where adjusting entries come to the rescue. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. There are two main types of adjusting entries: prepayments and accruals. Prepayments occur when goods or services are paid for in advance, while accruals happen when goods or services are delivered or consumed, but the invoice and payment occur at a later time. Let's start with prepayments. Imagine walking on a tightrope, balancing between the past and the future. In a prepayment scenario, the payment for goods or services happened in the past, but the actual delivery or consumption of those goods or services will take place in the future. In accrual accounting, we want to recognize revenue as it is earned and expenses as they are incurred. So, we need to make adjusting entries to remove the impact of prepayments from the past and recognize them in the future when the goods or services are actually received or consumed. On the flip side, we have accruals. Imagine a time machine that takes us back to the past when goods or services were delivered or consumed. The substance of the transaction happened in the past, but the natural accounting trigger, such as the issuance of an invoice or receipt of payment, occurs in the future. To align with the accrual basis, we need to make adjusting entries to record the revenue or expenses in the past, and then reverse them when the invoice is issued or received in the future. So, adjusting entries are like the bridge between the past and the future, ensuring that our financial statements accurately reflect the true nature of the transactions. By making these adjustments, we can provide a clearer and more reliable picture of a company's financial performance. Now let's talk about the specific types of adjusting entries. For prepayments, there are two categories: prepaid expenses and deferred revenue, also known as unearned revenue. If you're on the buying side of the transaction, you deal with prepaid expenses because you're the one receiving or consuming the goods or services. On the other hand, if you're on the selling side, you encounter deferred revenue because you've received payment in advance for goods or services you will provide in the future. When it comes to accruals, again, there are two categories: accrued expenses and accrued revenue. If you're the buyer, you face accrued expenses because you're the one receiving or consuming the goods or services without an immediate invoice. Conversely, if you're the seller, you come across accrued revenue because you've already provided the goods or services and plan to invoice the customer in the future. So, adjusting entries are absolutely essential for bringing our books in line with the accrual basis of accounting, which is required by both GAAP and IFRS when preparing financial statements. By understanding and properly recording these entries, we ensure that our financial statements provide an accurate and reliable reflection of a company's financial health. Adjusting entries serve as a bridge between the cash transactions and the accrual basis of accounting. They enable businesses to accurately reflect the timing of revenue and expenses, ensuring that financial statements provide a true depiction of a company's financial performance and position. Whether it's handling prepayments or accruals, understanding and properly recording adjusting entries are essential skills for accountants and financial professionals. By mastering this concept, you can ensure that your financial statements are reliable and compliant with accounting standards. So, as you continue your accounting journey, embrace the world of adjusting entries and unlock the power of accurate financial reporting. What are some challenges you've faced when dealing with adjusting entries in your accounting practice? How did you overcome them? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications so I'll see you in the next episode of Counting Coins. Happy accounting!